IonQ stock is up over 257% in 2024. It's been a remarkable year for quantum computing stocks, in particular because of the developments, especially late in the year since October, when a flurry of new developments came out, and more specifically, the announcement from Alphabet about its quantum computing breakthrough really put fuel on the fire in some of these quantum computing stocks. All that being said, should investors buy IonQ stock for 2025? That's the question I'm going to answer in this video, looking at the company's metrics and critical financial performance numbers to make that estimate for whether I think the stock is a buy, hold, or a sell for 2025. So let's take a look. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So like I mentioned in the introduction of the video, the price action has been remarkable, especially since October. Actually, all the way up until October, the price was down on the year. IonQ investors were losing money all the way up until October, and then the action really exploded, and you see this big increase here, and it's now up over 257% year to date in 2024 with only one trading day left in the year. So most likely investors are going to experience excellent gains in IonQ stock for 2024. But what about 2025? Should investors buy the stock for 2025? Well, looking at the company's revenue and cash flow performance, you'll notice that it is gaining more acceptance as a product, as a service. IonQ's trailing 12-month revenue totaled $37 million, which is significant for quantum computing stocks. It's one of the companies that generates the most revenue in the quantum computing space at $37 million. This is still a very, very new industry. It's in its infancy and it's still growing. It's still really early stage here. And so companies like IonQ are just trying to establish themselves, trying to find commercial use cases, commercial applications for their product, for the quantum computing industry. So very early stages, and understandably, they are losing a lot of money. Cash flow from operations in the trailing 12 months was negative $93 million, negative $93 million in the year. So whenever I see companies like this that are losing so much money, that so much cash is leaving, the balance sheet becomes more important in these cases. When I'm looking at a company like Apple or Microsoft, the balance sheet is not very important in those cases. These are massive companies that generate close to $100 billion in cash flow. And so if they have some debt, it's okay. If they don't have too much cash on hand, it's okay because the business generates so much cash, and they're nowhere near insolvency. They're nowhere near having cash trouble. And so the balance sheet is not that important. For a company like IonQ, the balance sheet is absolutely critical. And so looking at IonQ, the company has $30 million in cash and zero long-term debt. That's a strong balance sheet. That's a really strong balance sheet. And another thing I like to do is take the cash on hand and compare it to how much money they're losing. So they lost $93 million in the most recent trailing 12 months. So let's say roughly $8 million or $7 million per month this company is losing. Between $7 and $8 million they're burning through their process of operations, right? Doing the research and development, paying for staff members, etc., etc. That's how much money is leaving the company every month. 7 and 8 million. So compared with how much money they have on hand, 30 million, if they're going through 7 or 8 million every month, that's only about 3 or 4 months of cash that they have on hand. The good news is that they have zero debt, so they can borrow money if they need to. Also, the good news is that the stock price is up over 257%. So like they've done before, they can sell shares of stock to raise capital to fund the business moving forward. And perhaps they've done so already, and that information has not yet been incorporated into these results. These results include quarterly updates. And so if the company has made some changes between quarters, when they update investors officially, then those numbers might not be incorporated in these results. So I think it would be prudent for management to raise capital when the stock price is up as much as it is to shore up the balance sheet, to strengthen the balance sheet. And I know management in the most recent conference call talked a lot about raising capital at this opportune moment to shore up the balance sheet to give the company more runway before it runs out of money. I also like to look at the valuation on a forward price to earnings multiple, but we don't have earnings for IonQ. The company is negative earnings, it's negative cash flow. So one of the other options I have is to look at it on a forward price to sales basis, and it's considerably more expensive on this basis as well, given the big stock price increase. And that increase in stock price hasn't come with an increase in sales. So one example I like to give in this case is NVIDIA. NVIDIA's stock price has increased by a lot in the last 2 years, but NVIDIA's sales, profits, and cash flow have also increased by a lot. So NVIDIA's stock price increase is justified by the increase in sales, profits, and cash flow. And there have been other stocks like IonQ, like Tesla, like other quantum computing stocks, where the price has gone up, but there hasn't been that increase in sales, profits, or cash flow to justify that increase. So the increase was only driven by enthusiasm, momentum, excitement, these intangible things that are not yet reflected in the company's financial performance. They're just expected, something in the future, something exciting about the future of this industry. That's what's driving the stock price increase, which is a riskier type of increase in stock price than if you have an increase in stock price justified by increases in earnings, profits, and cash flow. And so looking ahead, the company's earnings per share expectations over the next few years, they don't look very good. In 2024, the company is expected to lose about 87 cents per share. In 2025, they're expected to lose 99 cents per share. So the losses are expected to increase per share, even though they're going to have more shares outstanding. And so the losses can be split among more shares, thereby reducing the loss per share, but still increasing earnings per share. So that's not a good sign. And then 2026, the losses are still expected to be quite high at 97 cents per share. And then only in 2027 are they expected to really improve the losses on the bottom line down to 48 cents per share, while they're still going to be losing money. This company is likely still going to be losing money for a very long time, probably until the turn of this decade here. So all that being said, should investors buy this stock for 2025? Should they hold or should they sell? Well, there is a lot of potential for IonQ. They do have some significant research and some significant progress, and quantum computing is a very innovative area that could unlock huge potential. However, the price has already increased by so much and the valuation is so rich that I don't feel like the reward justifies the risk. And so for now, I'm rating this stock as a hold for 2025. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.